Thank you for joining us for another edition of the Market Commentators podcast. My name is Andy Wilms, President and CEO of the Milwaukee Company. And joining me this morning is Mike Wilms, who is the Milwaukee Company's Chief Operating and Compliance Officer. A quick reminder that nothing in this podcast should be construed as investment advice, and the views expressed during this podcast represent Mike and my personal views and not necessarily those of the Milwaukee Company. And with that having been said, I'll welcome you and say good morning to you, Mike.
Good morning, Andy. I'll spare you wearing my Green Bay Packers mask, so.
Oh, you had it a little dedicated. Yeah, I have mine. Where did I do with it? Right here. But since my door is closed and I'm in my office and my windows are open, I think I can avoid the mask for the podcast. But anyway, let's get started. And to get started, I thought I would just begin with a market recap of, as we usually do, and begin that with some of the major developments last week. One of the biggies was that the Commerce Department released its initial estimate of America's GDP for the second quarter, and it showed that the GDP had contracted by 32.9%, which is the steepest drop ever by a long shot.
Now, I would qualify that a little bit because what the government statistics represent is the quarterly drop multiplied by 4. So it isn't necessarily a true annualized drop of 32.9%. But on a quarterly basis, it's the worst number in history.
Yeah, exactly. But as bad as it actually was a tiny bit better than expectations. So expectations were really bad. Investors didn't seem to really care. I see almost shrug their shoulders and says, you must have me confused with someone who gives a damn. As the NASDAQ ended up 3.69%, the S&P was up 1.73%, and the Dow was up was basically flat. That ticked down 16 basis points. So,
and I think that's a good indication that the market is forward-looking.
Yeah.
Because each of the Federal Reserve banks has a number of economic calculations that they put together on a weekly, monthly basis. The Atlanta Fed has a GDP forecast that they have rolling forward on a daily basis. And as of yesterday, they were forecasting a 19.6% GDP increase in the third quarter. And that's pretty close to where the blue chip economic forecast is, which is a aggregation of the top economists in the country. So, I mean, they're looking for almost a 20% GDP increase on the same basis as the decrease in the third quarter.
Yeah, of course, that forecast is made vulnerable by the fact that, more and more states are starting to take more severe rollback of their coronavirus protections. Louisiana now has announced some additional cutbacks. And so hopefully, we don't have to, roll back to the point where that number gets jeopardized too. And the stock market, as you said, it's forward looking, but it's also, and its crystal ball, so to speak, was pretty good so far when it comes to the mega cap stocks, because Apple, Amazon, Facebook, and to a lesser degree Alphabet, which is of course the parent of Google, all announced very impressive profits last week. So the run up in their price before those announcements was justified, it seems, at least in part. And the Federal Reserve also announced that it would not be changing interest rates or its stated policy of doing whatever it takes to meet the economic challenges of the coronavirus. I think Chairman Powell said he was not thinking about whether he should be thinking about raising rates. So, I mean, it pretty much emphasis that it's not something they're going to be doing anytime short. In terms of this week, the major index all were up significantly higher on Monday as investors continue to keep their fingers crossed for a breakthrough on the next stimulus bill. And of course, big stocks as usual, big tech stocks, I should say, led the rally. And then yesterday it was kind of a ho-hum day. Stocks rose a bit, even though Congress still hasn't agreed on the details of Stimulus 2.0. But it does seem that both sides have indicated that they will send out another $1,200 stimulus check. The big issue seems to be how much additional unemployment assistance should be given. So that's pretty much what I have for the recap on the markets. Why don't you give us a recap on COVID-19, Mike?
Well, the statistics yesterday on the number of infections and death rate were a little concerning. There had been a trend lower in the infection rates running in the 60,000 plus per day to the mid 40s. There was a spike up to 54,000 yesterday, and deaths were over 1,000 on the day. The previous 3 days, the death rate was more around 500. Actually, 2 of the 3 days it had been less than 500. So, to your point earlier about some of these states rolling back their reopening plans, there really needs to be a focus on getting the new infection rate down and mitigating the death rate. So, in addition, there's been a fair amount of news since the last podcast last week on the vaccine front. Everybody's moving forward. 2 of the vaccine candidates are in large phase 2/3 clinical trials, 30,000 plus patients. Johnson & Johnson had a positive news release on progress with their novel vaccine candidate in non-human trials, actually in a type of monkey. And there was a news story announced here this morning that federal government has contracted with Johnson & Johnson for over 100 million doses of the vaccine, assuming it progresses forward. The Moderna and Pfizer / BioNTech vaccines, which are messenger RNA based, the mRNA vaccines are continuing to move forward. They're in the 30,000 plus patient phase 3 trials. Novavax had positive results on their virus vaccine yesterday, and they also have a novel design it's based on a coronavirus protein where they amend the genetic material of an existing virus where the virus doesn't reproduce. So, the finest minds in the scientific community are fully engaged on trying to find an answer. So it's pretty amazing what's all being done.
Yeah, it really is. And as I understand it, the Novavax vaccine kind of stands out because it's protein based, and that's the same type of technology that was used to treat existing diseases like shingles. So that could make it a safer and easier vaccine to crank out in really large amounts.
Well, and that's a great point. I mean, safer and simpler. The Johnson & Johnson vaccine only requires 1 shot, and several of the other vaccine candidates require 2 or more.
Yeah.
So,
but it is all good news. President Trump, the eternal optimist, said yesterday that he is very convinced that by the end of the year we'll have a safe and available vaccine. Obviously, he's not saying we're going to have everybody in the country ready to, but he thinks that we could have a vaccine ready to go for the people on the front lines before the end of the year. And God, I hope he's right. Cross your fingers. There does seem to be some justification for that optimism, it seems to me.
Well, and I don't want to muddy the waters necessarily, but looking at the vaccine progress globally, I mean, both Russia and China are saying that they'll have vaccines ready as soon as September.
Yeah.
And so there isn't a whole lot of transparency on clinical data relative to their candidates, but Putin said that their vaccine is 100% effective.
Yeah. And it'll be interesting. So you'll have different vaccines used in different parts of the country. And I think there will be multiple different vaccines out there, and they'll figure out which vaccine's best for this age group. There's different strains of the coronavirus, which one is better for which strain. But I also think you'll see, if Russia comes out with a vaccine and they say, and it's not so effective, I think you'll never know it from the numbers they're going to publish. They're not going to tell you how effective or ineffective it is. I think you'll see the number of coronavirus cases in Russia plummet, regardless, or in China, plummet, even if the thing is totally ineffective. That's just.
That's had a cynicism there by chance?
Yeah, a little bit. What can I say? But we will see. But actually, I shouldn't laugh. That's not a laughing matter, because if they start cooking the books to make their vaccine look good, that could be a real problem, obviously.
Well, and then the only other thing that I think is worth noting is on the convalescent plasma side, there were clinical results released where using blood plasma from a recovered patient with a high level of antibodies reduce the death rate in severe cases where people are hospitalized by 50%.
Oh, well, that's really impressive. I mean, that's fantastic.
So, and that's over a study of 3,000 patients. So
it's a big study. Yeah, that's great.
So there's a lot of positive.
Let's shift a little bigger scope topics now and discuss, as I usually like to do, a couple of issues. The first is, I pointed out my newsletter article for last week, which I'll put in a shameless plug. You can find on our website under our media tab. I pointed out that the stock market and the economy have done things and behaved in ways that we've never seen before, and it raises some questions of whether or not the markets have been transformed in some sort of permanent way. I mean, some of the first we've seen already is the fastest market sell-off and bounce back in history. We've seen, as I mentioned a moment ago, mega cap tech stocks dominating the major indexes as we've never seen before. We see mortgage rates at record lows, government bond rates lower rates than we've seen in over 200 years, gold hitting all-time new highs, and young and inexperienced investors flocking onto the market in record numbers because of easy online low-cost trading. And so you see a lot more speculation. We're all tend to be a little more speculative. I know I was when we're in our 20s than when we're in our 60s. So the question is, that I want to pose to you, is do you think this time it truly is different, that technology and other things have made a permanent change in the way the market behaves? And if so, what does that mean for investors in your mind?
Well, from the technology side of things, I think there will be a change in behaviors relative to the way you office and the way you shop, and a number of those type of considerations. There's some questions around the real estate market and what the effects are going to be on demand for office space, with people more focused on being able to do a Teams or Zoom meeting from wherever they're located, whether that's at home or in an office setting. But I think the real main difference here is the level of intervention by the central banks worldwide, with the Fed kind of leading the way. I had read something about their intervention with swap lines and providing dollar loans to all the other central banks early on when the financial markets were experiencing difficulty. and there really wasn't anything in the press about the magnitude of those swap line interventions.
Right.
And everybody seems to embrace the central bank roles in providing stimulus to the economic challenges that were presented by the virus. And, you know, it goes to the old adage, don't fight the Fed.
Yeah, it certainly does. And, you know, it does strengthen the dollars, actually strengthens the dollar's position as the reserve currency, the activities that the Fed has engaged in and these swap arrangements. From an investor standpoint, I think, you know, investors need to take note that the stock market's future performance could really look a great deal different from what it has in the past. And so, you know, as a result, back tests of strategies, you know, may prove to be less reliable. I mean, here at the Market Company, I've always favored, you know, 20, 30-year look backs, right? Because we wanted to try and make sure our strategy and testing them 1,000 or 2,000 times, you know, with different alternative scenarios using the data from a 30-year look back. Well, you know, it's getting, what happened 30 years ago is maybe less and less relevant in terms of trying to anticipate what's going to happen tomorrow. And so we may have to adjust how we, you know, test our strategies, and we may have to adjust the way those strategies work. We've always kind of tried to use stable signals that had a sound long-term basis and data, but now it's becoming necessary, I think, to put greater emphasis on more what they call nowcasting, more day-to-day data type signals, and use those in conjunction with one another rather than relying on either the very current signal or the more stable ones. So it will have an impact on how people invest their portfolios, and I think it should have an impact on how managers evaluate their investment strategies as well.
Well, and I think that's very true, and you know, I think everybody, whether you're a professional institutional investor or an individual investor, is experiencing the same level of anxiety over all of the uncertainty. And you know, it's really hard to make the right decisions because it's hard to pick the right data set to base your decision on.
Exactly.
And a great indicator is there's $5 trillion sitting in money market funds,
which is just shocking. And you know, the old adage has always been the most dangerous 3 words in investing are, this time is different. No, 4 words, I guess. Dangerous 4 words in investing is this time is different. And so I hate and I've always been a believer in that. So I hate to say, oh no, you know, this time is different, but I do think there may be some fundamental change. We have to be at least receptive to the possibility without making a firm decision, but we do need to be receptive to that possibility. And one of the things that is different, which we can talk about now, is something that Deutsche Bank pointed out, and I mentioned a moment ago, that we're now looking at the lowest government bond yields in well over 200 years. And with bond yields being so low, you kind of have to ask yourself, why would anybody invest in bonds now? You know, traditionally we invested in bonds because they were considered safer than stocks. But when you're buying, if you buy bonds at very, very low interest rates, you have a serious interest rate risk. Whereas if the rates go up, your value of your bonds will go down. So, Mike, do you think you think people should be giving up on bonds and pulling out of them, or what would you tell people to do?
Well, and we've had internal discussions that
no doubt.
You're part of where some of the firm members have talked about the potential for capital gains owning the 10-year on 60 basis points.
And nobody's come to blows. No one's come to blows.
Yeah,
it's a heated discussion. So far, we haven't put up the ring in the backyard.
No black eyes yet, but to this point, in just a week's time, that argument would carry the day with the 10-year currently at 52 basis points. So you know, it circles back to the uncertainty that we had just talked about, and you know, historically yields on the Treasury curve are at historic lows. here in the U.S., at least they're still positive. I don't think rates are going to go to a negative here in the United States, like in Europe or Japan. But it's not your father's bond market
That's
anymore.
And there's always been like these three main reasons for investing in bonds. First was yield, and that's kind of out the window for the time being, at least, right? And the second was safety. We figured that as long as you held your bonds to maturity, you were pretty much assured of getting your money back. And that's true. But if interest rates go up, you're going to see the value of the bond, not the maturity value, but the market value, be affected negatively, and maybe in a big way. So that's been undermined, at least to some degree. And then there's the negative correlation with stocks, which is very important, right? And that's still is still legitimate. I mean, I think still present. Except for times of extreme crisis, there's tends to be a strong negative correlation between stocks and bonds. And so they do help provide stability to a portfolio. They can be used to rebalance the portfolio, right? Because when your equities start to get overweighted or get frothy or overvalued, you rotate into bonds to use to rebalance the portfolio. They protect against deflation, because if the value of the dollar actually goes up, then the value of the principal and the interest you're receiving goes up too. So the big problem is, though, they are vulnerable to rising rates, and so I think you do need to be careful about that, and so we are, as you point out, taking a hard look at other alternatives that might be a good candidate to provide the stability that we're looking for without as much interest rate risk. But unfortunately, alternatives are limited in that regard. I mean, CDs and savings accounts pay basically nothing. Dividend stocks are kind of enticing because they pay higher yields, but they have other risks, obviously that you have to assume. And, then you can get into the whole alternative investment world. But, I always say never invest in something you don't understand. And most of these alternative investments are kind of very dark, clouded type of things. You can't really figure out what the heck's going on behind the curtain.
And I would agree with the opaque nature of alternative investments.
Yeah,
they don't want you to see what's under the hood.
Exactly, which makes me very nervous, and something I personally would not ever invest in if I can't see what's under the hood. So all that being said, I think it is a very good time. We are, as I mentioned, in the process of looking at, alternatives. But before you jump into alternatives, you really need to be careful about it and make sure you're still getting the diversification benefit that is the primary reason for owning bonds. I think we have time for one more question here, Mike. So I'm going to jump. I just thought it'd be fun to talk a little bit about the grilling that the chief executives at Amazon, Facebook, and Apple and Google got last week when they testified before Congress for more than an hour. I kept a recording of that so that if I couldn't sleep, I could have something to put me under, because that certainly would. There wasn't a whole lot that come from the hearing, but I was wondering, they were getting lambasted from all sides. The Democrats, the Republicans all found fault with these guys. And President Trump didn't want to miss out, so he sent out a tweet, and I'll quote him: "If Congress doesn't bring fairness to big tech, which they should have done years ago, I will do it myself with executive orders. In Washington, there's been all talk and no action for years, and the people of our country are sick and tired of it." According to, so apparently these guys who have led the world in development and technology and have brought countless number of jobs to the United States and have combined GDP of I think it's the 17th, equal to the 17th or 18th largest country in the world. Apparently, one thing Congress and the president, both houses of the Congress and the president can agree on is that these guys are all a bunch of jerks. And they just, and I don't know, do you think these guys are the bad guys and deserve all this criticism?
Well, okay, so If you scroll back, I'm not exactly sure how many years back, Europe teed up their first investigations in the monopolistic nature of the size of these businesses, and they started with looking at some kind of tax for Google and some mechanisms for breaking up the companies from an antitrust perspective. There's been so much question about how these websites or these technology companies function. But the most recent statistics I saw, 1.74 billion people sign on to Facebook every day. Okay. And everybody's aware of all of these problems that are alleged, and yet everybody continues buying on Amazon, even though there is all of the rhetoric out about how that destroys mom and pop businesses in local communities. Google Google does 80% of the searches online every day. Microsoft's cloud business continues to grow. The only reason the companies are as large as they are is they are providing the market what the market wants.
Well, I agree. And there's, you have to have a certain amount of size to do these things, right? I mean, of all the time to go after these guys, which I'm not saying there isn't some legitimate concern on the growth of these companies. Clearly there is. But if Amazon wasn't as gigantic as it was, and they have the delivery and, the vertical integration that they have, how are you going to possibly get through this pandemic? They have played an incredibly valuable role in getting us through this pandemic. If you didn't have companies like Microsoft, as large as they were, we could not be having this discussion online right now, right?
Exactly.
You have to have, so all of the business that we're able to be conducted because of the technology companies able to provide. I mean, the internet has worked fabulously during this whole thing. And yet we somehow, and that's only because tech companies have gotten so big that we have such a well-functioning. So, and I think
you have to look at it from the perspective of the only way they could have gotten this big is they invested in the infrastructure. So right. The server farms, the actual fiber in the ground, they needed to make the capital investments to have a scalable business to perform as amazingly as they have in this unprecedented challenge.
I'll just conclude with two quotes from the hearings. The first was Mark Zuckerberg, and he said, "History shows that if we don't keep innovating, someone will replace every company here today," which I think is very true. And I'll maybe a bit controversially quote Sensenbrenner, Representative Sensenbrenner from Wisconsin. He said, "In America, you should be rewarded for success." And I certainly agree with that. So I guess that's enough said on that topic, and probably enough said for today. So I will wrap up on that patriotic note. And hope you have a great rest of your day, Mike. I hope all of our viewers do the same, and I'll look forward to talking to you again on our podcast next week. All
right, Andy, I wish you a great rest of the day also, and thank you, everyone.
Bye now.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.